morning. I'm Ross from Coombs Smith 150 Group Property Accountants, and we're looking today at a simple example of how you can save over 10,000 in tax, actually over 14,000 in tax in this example. And it is a real life example. It is someone who actually does have this situation. So yeah, it's worth looking at the different things. And obviously we all want to pay less tax legally. So this is just a simple case study of going through how you can save less tax on a rental. So we've got Jack and Jill. Jill earns 200,000, so she's on the 39% tax bracket. Jack earns over 70,000. He's in the 33% tax bracket, obviously below the 180,000 threshold. They've got 3 children who are 14, 16, and 18. They also support Jill's parents, and in this situation, they don't get super or don't get any other income, so they have no income at all. Jack and Jill are doing really well. They've got some rentals or rental property in their LTC, and it's making $65,000 of taxable income per year. So yeah, either at the moment that could just be really good cash flow rental, or they could be slowly losing the interest deductions and obviously making more taxable profit under the new rules and paying new tax. So obviously this is a couple who are making some good income, but there is lots of rental properties owners who were making really good income, and who there is many who still are as well, even with the even with the interest rates going up, and especially with the tax changes coming in. And they've got no personal debt. Yeah, how much could smart structuring save them? And this is obviously something we look at all the time with clients. Yeah, when we're giving advice and instructions and giving property advisory meetings, obviously something we're looking at, a real important thing is getting the structure right. So obviously this presentation, just some general information. It's not specific advice. If you need to review your structure, you're paying way too much tax or not set up really well, come and see me, come and have a proper meeting, and let's do this properly, but this gives you some basic ideas. So a poor structure, and this is how a lot of people are set up. They might have an LTC, it's making the 65,000. They've got their personal names owning these shares, and to me that is a really poor structure. Or it could be that the rentals might be in your personal name, so they might have been in Jack's name owned personally, or in Jill's name owned personally, or they could be in both the names. Either of those would be, to me, a pretty poor structure in this case, and yeah, just lots of other opportunities. When we come to tax, obviously Jill is getting half of it. She's earning 200,000, so she's taxed at 39%. Jack is getting the other half because they own this property together, or sorry, they own the LTC shares together. They've got 50-50 shares. Jack's getting taxed at 33%. They're paying 23,400 tax per annum. So that to me is the bad structure. Then we look at, hey, if we just had an open book, if I could start from scratch, what could I do instead? So a structure we use quite often is an LTC owned by a trust. Yeah, we do smart little things, like if the trust is advancing money to the LTC, it does it formal loans with a general security agreement or some other security your lawyer might advise. The trust might own your personal house, so you're getting asset protection. Jack or Jill get sued, their assets are protected within the trust. So it can give lots of good benefits as well, and lots of other smart things we can do. We can also allocate to children, lower earning spouse, or potentially parents as well. So look at it this case. Say that we allocated 14,000 to the 18-year-old. Note that I've got spend in there. So what I'm saying is we don't just want to allocate 14,000 to the 18-year-old, because then the trust owes them 14,000. So generally we would be looking at the trust spending money on the 18-year-old to offset that. And we've gone through that in other videos, and we've got another trust webinar coming up which goes through that a bit more. But yeah, really important not just to allocate the money, you've also got to spend it so you don't end up owing your child thousands of dollars. So in this case, maybe we allocate 14,000 to the 18-year-old and spend it on them. We allocate 14,000 to the 16-year-old and spend it on them. We allocate 1,000 to the 14-year-old and spend it on them. Each of these are taxed at their tax rate. So say they're not earning, this would be taxed at 10.5% to the 18-year-old, 10.5% to the 16-year-old, and tax-free to the 14-year-old. And you can only give $1,000 a year from a trust to someone under 16. So yeah, and then we've also got the parents. So Jill's father is not working at all. So we could allocate him 14,000. I've said that Jack and Jill are supporting the parents, so likely rather than them paying for the support, the trust could pay for the support and then allocate them 14,000. The same to Jill's mother, another 14,000. So what we're up to at the end of all this is we've got about $8,000 remaining. They had 65,000 profit, 14,000 to the 18-year-old, 14,000 to the 16-year-old, 1,000 to the 14-year-old, 14,000 to Jill's mother, 14 to Jill's father. We've used up most of the profit. We've got 18,000 remaining. We could probably be smarter and allocate some of this potentially to the beneficiaries as well. But say we don't, we could keep it in the trust at 33%. Our total tax bill is now 8,520. So I've got a little bit of a breakdown. Yeah, the 18-year-old's taxed only 1,470. Same with each of the other. The 14-year-old has got no tax because only the $1,000. And the trust has got 33% on 8,000, 2,640. So our big summary, our tax was 23,400. We're now 8,500. We've saved 15,000 per year in tax. So obviously there's a huge opportunity around this, and just a simple part, if we just concentrated on the 18-year-old, that 18-year-old's paying tax at 10.5%, 1,470 on 14,000. The trust would be 33%, so it'd be 4,620. We're saving 3,150 per year. So if you don't have the two teenagers, 16 and 18, don't have the parents that you're supporting, it's still potentially just one of these can do large tax savings. Or we might have it where a wife is working and not the husband, or the husband is working and not the wife. Lots of opportunities to trust, lots of potential with it. So like everything, there's catches. So what you need to think, the main one is, what is your commercial reason for doing that? If you're just doing it for tax, it's tax evasion or tax avoidance, and we're all going to get in a lot of trouble. So you need to think about what is the actual commercial reason for doing this, and the easiest one is to do it at the start. When you're setting up structures, set them up right and smartly from the start. That's the easiest. If we transfer shares, there can be major tax implications. We can end up with a taxable sale. We can end up restarting Brightline. We can lose interest deductions. Real nasty things. So we need to be really careful with it. But yeah, to me, if you've got a bad structure, you've got all the income going to the highest income earner paying 39%, or you've got a lot of children, a lot of other beneficiaries, you do a lot of charity work or something like that, potentially there's some really smart structures we can work, and it's worth just having a free chat with us to start with our team, and then maybe having a paid property advisory meeting with me just to go through what you can do with your structure, some smart things that you can do. I'll put that link up in the comments as well, but obviously you can get it off the end of the video. So to me, really important, review your structure, see if there's smart things to do. This example showed you how you can save 14,000 a year for their smart structure for this particular client setup. But even if your setup's not that much fun for me, there's still often things that we can do just smart, easy to save 2,000, 3,000, 4,000 a year, just smart little things, just looking at it carefully. And again, being careful, what's our commercial reason? Why are we doing this? And being careful changing shares without getting advice. So hopefully you've enjoyed that. I'll put a couple of links down the bottom and in the comments. Thanks a lot for your time. Bye.